So let's talk about technical analysis. This is the number one form of analysis that I use every single day to identify which trades are going to be most profitable for me and which ones should be avoided. Technical analysis is using previous price data to create a visual representation about what is going to potentially come in the future. It's focused on using actual data, price, hard numbers that have happened in the past to make logical predictions about what's coming in the future. This is not concerned with focusing on the forecasting of a news event or what might happen with this central bank. It's focusing on what happened on the chart and how can we react to that price movement. Now, there are three simple principles when understanding technical analysis. Number one, history repeats itself now more than ever. That's because, as we talked about earlier, a lot of the trading is driven by high-frequency trading robots and algorithms. These algorithms, computer programs, do create patterns that repeat. That's how they're able to make money passing large orders back and forth. Now, you have to then accept that the market moves as it does for whatever reason it needs to, and all we can focus on is how we can read it and react to it. I don't ever try to say things are for certain with this market because I'm not the one clicking the button on the other side of the screen. I'm not the market maker. I'm not the interbank player. They know why things happen. But for us, for people like us to try to speculate and be like, oh, news did that 100%, there's no way it wasn't this or that, it's just closed-mindedness. So you have to accept that the market's going to move as it does, and that has to almost be irrelevant. You need to read and react and identify profitable patterns. Now, the reason we use these repeatable profitable patterns is because price moves in trends. Contrarians will always struggle in the Forex market. People that are trying to call tops, call bottoms, you're always going to struggle. It is much easier to identify a trending currency pair and ride that trend for days, weeks, months, however long it may continue. And that happens much more often in the Forex market than in the stock market. So it's a huge, again, benefit to the market itself. Now, I spoke a little bit about this earlier, but it's important to understand the difference between forecasting and reacting. Forecasting is talking about what should happen. Reacting is focused on what already happened. Reacting makes it easier to make profitable decisions with your trading. It makes more sense to the logical, analytical mind. And the people that make the most money as traders, typically, of course, there's, the crazy Wild West traders that do make money, but typically it's the logical and analytical people that are really consistent over the long term in trading. And they are focused on reacting, not forecasting, not worrying about what they're saying on CNBC, not worrying about what Forex Factory is speculating on. What's the news event coming? How do I avoid getting chopped around in that? And then when can I find the next best setup? Reacting to what the technicals have already showed me. So now comparing fundamental analysis to technical analysis is very important so you can contrast from both angles. A healthy combination of both fundamental and technical analysis is needed for profitable trading. The fundamentals are going to keep you trading during the safest period of times because you're going to understand when you should be looking at the news, when you should be out of your trades, and when it's clean, when there are no news events to shake you out of trades. The technicals, on the other hand, are going to show you the highest probability trade setups. This is going to tell you when to get in, when to get out, and why you need to be doing that. One is not more important than the other, and I can't stress that enough. They both have to be used, and neither can be ignored. So let's talk about the market characteristics, what actually is the backbone of the Forex market. Now, I told you earlier it's a global market. It's open 24 hours a day, 5 days per week. Now, that wide range is broken up into smaller individual trading sessions determined by the market that's open at that time. So the week is started and each day is started with the Asian market opening. That combines, for me, the Australian market and the Japanese market together. We consider this the accumulation session for each day. What that means is that brokers will pool their orders to set their initial high and initial low for the day. Very few large moves happen during this session. And if I do ever trade this session, it's to trade a Asian market pair, New Zealand dollar, Japanese yen, for example. I would never try to trade the pound to the Canadian dollar during the Asian market. There's not going to be any volatility in that. So you need to just understand the Asian market is from 5 p.m. to 1 a.m. when we talk about those first 8 hours of the trading day, right? And an accumulation zone for the day. You can see here, I have some chart examples for you. You can start measuring this on TradingView from 1700 to 1 a.m. So this is 5 p.m. to 1 a.m., the first 8 hours of your day. When you box that off, you're creating the initial high and initial low of the day, which is set with pins. When we do our analysis, a lot of the time we're going to talk about bodies, but one of the few times I do let you use pins for your analysis, the high and low of each candle, is when boxing off your Asian range. And here, we drew it to the top, we drew it to the bottom, and that is our Asian session. What this tells us, and you're going to even start to see it here in some of these examples, is that if we can't break out of that Asian range, as you see in this example, you tend to see that market chop majority of the day until it does break out. And even here, as it tries to get out past that high, it has a very hard time doing so. So what we tend to look for is pairs that break the Asian range, retest it, and then move off of it as a significant level. Here, we see that breakout of the Asian range, which is shown with the purple horizontal line, a beautiful retest, and as the morning progressed, 6, 7, 8, 9 in the morning, we saw that move off that Asian session low. Now that can tie into the best time of day and best days of the week to trade. So if you understand when the Asian session is and you understand that you should only be trading markets that are open during that session, you have to then logically be able to put together that the Asian session is not going to be the best time to trade because there's not a ton of volume. Volume is opportunities, right? And no one drinks when the watering hole is dry, as we like to say, right? The most trading in the world is done between 2 a.m. and 12 noon New York time. That's because that's when London and New York both overlap each other. Now, Monday and Friday are your 2 weekdays where you're not going to find a lot of volume, you're going to see a lot of news, and you might get chopped around. Not always. There's sometimes great trades on Monday. Actually, filming this course, we had a great trade this Monday. But you'll sometimes also see those days have less volume. Your Tuesday, Wednesdays, and Thursdays are much better for your trades. Those are where you're going to find your midweek trends, where you're going to be able to take advantage of the same direction, the same pair for multiple days. Another big piece to the market itself is average daily range. You have your Asian range, you have the best days of the week to trade, but within each day, the average daily range is the range that the pair has moved over the previous 5 or 10 days from pin high to pin low. The way to figure this out is to add that up each day and divide it by either 5 or 10 to come up with your 5-day or 10-day ADR. ADR is very important when you consider taking a trade if you're a, again, logical and analytical trader. Why? Here's your example. If you're trading a currency pair that has a 50 pip average daily range over the last 5 days, that pair today is looking like it could present you an entry, but it's already moved 48 pips. And the last 5 days, it has not moved more than about 50. Would it be really logical to go in and try to take a trade when it's already almost maxed out? It's basically already maxed out its average daily range. It's average for the day. No, it would not make sense. So when you apply logic to it, of course, you might miss a trade where it goes 50 pips higher. But that's not trading, that's gambling. Trading is sticking to rules. And more often than not, you'll lose if you try to trade into a pair that has already reached its average daily range. So what we do, we use average daily range as one of our initial parameters in our checklist to see, is this a valid setup? Is there potential for me to make money in this? Are there pips available for me to grab according to what it does on an average over the last few days? Now, past that, we have a few different types of orders. The number one type of order that you need to understand, this is all I use, are market orders. These are instant fills. If you're using an ECN, you already know that what that means is you hit buy, you hit sell, your broker is shopping you around for the best price. That's what the ECN does. So that market order is normally instant, very little lag unless you have some personal internet issues, and that's going to get you in at the best price possible. There are a few other types of orders that you do need to be aware of, but again, I don't use them. I don't advocate for them. I think that if you're an active trader in the market, using market orders is always going to be your best bet. Please understand what limits orders are versus stop orders. Now, limit orders, if we're talking about a buy limit, this is placed below current price and filled with the hopes of price rising. If we're talking about a sell limit, that is placed above current price and filled with the hopes of price dropping. A visual representation is right here for you. A buy limit, as you can see, is placed below current price, hoping price will drop, pick up the order, and then continue higher at a later time. The sell limit is the opposite of that. Sell limits are placed above current price. Price will rise and reach it, but then continue back in its downtrend, hopefully, as time goes on. You can compare limit orders to stop orders. Now, stop orders are just as important, but again, I don't use these actively. A buy stop is placed above current price, filled on the way up. Sell stops are placed below current price, filled on the way down. And here's another visual representation of that. So you can see the order was placed above current price rises, picks up the order on its way up, and continues higher. The sell stop is the exact inverse of that. So again, there's multiple types of orders between the stop orders and the limit orders, but we are focused on market orders. Get me in, get me out as fast as possible. So let's get into some market structure. We're going to talk about drawing trend lines. Now, consistency is what matters most. You want to use bodies, not wicks. Remember, we were using wicks to draw our Asian range. But now when we talk about drawing trend lines, we're going to want to use the bodies of those candles. You're going to want 2 or more bodies to create the line. Now, uptrend lines are going to slope up from left to right across your screen, and downtrend lines are going to slope down from left to right across your screen. So in this example, this is an uptrend line created with the 2 reaction points circled here. Those are candle bodies where you start the line, and you can see that uptrend line is held as price continues to rise. Just as you can see here, in the inverse of that, there's a downtrend line sloping down from left to right, and you can actually see a third reaction point here where it respects that trend line very nicely later in the day. So the reaction point is created here and here. Those are your 2 points that create the line, like I said, that is respected here later that day. Now, keep in mind that trends are going to be your friend. Like I said, contrarians are going to struggle here. A bullish trend is going to show you higher lows and higher highs. A bearish trend on the inverse of that is going to be lower lows and lower highs. The reset of a trend, no clear trend, is going to be higher lows and lower highs. Now, being able to identify these trends is, number 1, very important on price action, but number 2, going to be confirmed with what you find on your technical indicators. The 3 indicators that we need are 1, exponential moving averages, EMAs, 2, a trader's dynamic index, TDI, and 3, average daily range. Now, average daily range is not a technical indicator, but it is very important, as we spoke about already, in your daily trading, in your daily checklist. So we want to make sure that that's always on that list as something we keep at the forefront. First, let's talk about exponential moving averages. They're going to help us confirm the trend, and using multiple EMAs can give you a quick update on the trend, the direction of it, across multiple different periods of time. So for people that sometimes will argue with me and be like, well, why do you need 5 different EMAs? For me, the 5 EMAs symbolize 5 different periods of time. And if more periods of time confirm we're in an uptrend, or more periods of time confirm we're in a downtrend, I'm going to have more confidence in the analysis and in taking that entry. So here you can see we add just 1 EMA on this yellow line. That'll be our 8 EMA. But I'm also going to add a red line, which is our 21 EMA. The 8 and 21 are different because the 8 is a shorter term period EMA, meaning it's only measuring data across 8 periods versus here, the 21, and here with the blue line, the 50. So as we add in the 200 and below that the 800, you can see all the EMAs help to paint the picture of where overall trend is going. If price action is above the EMAs, you're in an uptrend. If price action is below the EMAs, you're in a downtrend. Remember that, write that down. So here, with us above the 800 EMA, overall, we're still going to be long biased. We're still going to want to see this come higher for the most part. Not to say that we can't make money to the downside, but there's going to be more money for us in this position, in this pair, to the upside. When we talk about finding full trend, you can see here, as all the EMAs fan out in their proper order, meaning the 800 is below the 200 is below the 50 is below the 8 and 21. In that order, we would qualify that as a full uptrend. And on the inverse of that, if their 800 is on top, then the 200, then the 50, then the 8 and 21, that would be confirmed to us as a downtrend overall, a full downtrend. When we can find either a full uptrend or a full downtrend, regardless, we're going to find the highest profitability trades. Now, drawing support and resistance zones is another very important tool that you need to be able to use in your daily analysis, because when we move through, even if we can confirm trend with our EMAs, and even if we can use the TDI to help us spot the entry, which you're going to learn about in a little bit, you still want to make sure that price structure, market structure, is still on your side in the trades. Now, support and resistance, here we're going to flip back and we're actually going to use wicks to draw these zones. It's best if it's drawn on the daily time frame and the 4-hour charts, because the higher time frame zones are going to show us stronger areas of support and resistance. Now, the way to draw this is understanding if it's called the 2 candle rule. The 2 candles to the left and the 2 candles of the right can't be higher or lower, depending on if it's a support or resistance zone, than the wick. And I'm going to show you how to draw this in a second. Now, zones are not the end-all be-all indicator of what price is going to do, but they have to be analyzed and taken seriously. But at the same time on that, we can not forget that zones are able to be broken through. So zones are important to see. If they confirm the trade, you're going to feel great about it. If they don't confirm the trade, it might make you size down. It might make you reconsider the position. So here in this example, you can see the pin here, 2 candles to the left, 2 candles to the right are not lower than that pin. So looking at the chart left to right as price paints, that would be the first zone that we would find here on the daily time frame. You can see as that month progressed, that zone was respected here with a push off and now is being tested again for a second time. We would expect it, because it's in an overall downtrend with the EMAs pointing down, we'd expect it to push lower from here using the zone again as resistance. In a downtrend, resistance is on top, support is on the bottom. Keep that in mind. Now within these daily time frame zones, you can actually find smaller zones that are not as large as far as their size, but within the zones, you can see more strong areas of support and resistance. Now, test yourself. Can you see the support and resistance here in this example? I'll show you. You can see here the 2 candles to the left and right are not as high as that wick, so that would be a zone. Here, the same thing. This candle and this candle are not lower than this wick, so neither are these two on the right, which makes this a zone. And here at the bottom, we can see it was tested really well just a few weeks later. Again, on the daily time frame, just drawing simple boxes using wicks. Tested here, tested here. So when it came back down to this price again here, even though you were in a downtrend, you would be hesitant to try to sell it here because it had already bounced off it twice. You would want to be aware of things like that when you're trying to take trades. Now, you take the daily analysis and take it down to the 4-hour and the 1-hour, and you can find even more zones. And when you layer these zones, as I did in different colors here, you can really start to see the areas that are going to be key levels, whether they are support or resistance. And then if they switch, which can happen often, you want to be aware of them regardless, so you can, again, confirm or deny your trade ideas. So here, when we went from the daily to the 4-hour, we've now taken it down to the 1-hour and found that we are in a short-term uptrend with the 800 EMA at the bottom, then the 200 EMA, and we were also in a very strong level of support. That level was broken, retested, and used to create a new high. When we came back to this price, because the EMAs are in an uptrend, we would look to be long here if we could find an entry signal in anticipation that we would again push off that zone and move higher to retest the current high set. So here we have one more example of the support and resistance zones before we move forward into the candle breakout formations that I want you to be able to identify. Here you can clearly see support on the bottom in the uptrend with resistance on the top. Notice how that support set way back here at the beginning of 2019 was respected very, very well here at the end of June. Now also notice how the smaller support zone here right around the end of March caused a lot of choppiness here in the beginning of June. You can see how these zones are used continuously, not once or twice, but more times than that, to show us the areas where price is going to be sensitive, where it's going to have issues breaking through. Now, at this point, you should understand the difference between support and resistance, and you should understand how the zones are important, but they are not the end-all be-all. They are not the reason we go jumping into trades, and they are not the only thing that's going to keep us from getting into a trade. They just need to be analyzed and taken seriously to the extent that they are one piece of your overall analysis. Now, let's talk about 2 candle breakout formations. When we are looking at these formations, I'm going to show them to you in a second, understand that if we are going long, the right leg of your formation must be higher than the left leg, than the consolidation before it. If we're going short, the right leg must close lower than the left leg before it. And understand that the right leg must also come off the 21 EMA, always. So here is the first example of these 2 candle breakout formations. We have 2 EMAs on our chart right here. First, the 8 EMA is in yellow. Second, the 21 EMA is in red. These are 2 EMAs that when we get into the later chapters of this course, I'm going to show you the entry signals using these as our beginner entries, and then the more advanced entry signals that combine more EMAs into them as well. So here, back to the 2 candle formation, you can see the right leg of that 2 candle formation is higher than the left leg, as I said it needed to be if we were going long. So when this candle closes here, and this is on a 5-minute chart, you can see, so at the end of this 5-minute bar, let's just say it was 9:35, that would present the potential for an entry signal for us because the right leg is higher, it comes 21 EMA, and it closes higher than that left leg consolidation period. Here, you can also see short coming off the 21 EMA. The right leg breaks the previous consolidation zone. It actually breaks out for a new low of day, again on the 5-minute chart. And here, if you had entered on the candle close, you see you could have made money as it fell short from 3:45 all the way till about 5:30 in the morning. So now you understand the 2 candle breakouts. Let's look at the 3 candle breakout formations. This is 3 or more candles where the right leg must also be off the 21 EMA, just like in the 2 candle breakouts. And just like in the 2 candle breakouts, if it's long, the right leg must be higher, and if it's short, the left leg must be lower. Here's 2 examples of really nice 3 candle formations. You can see the right leg off the red 21 EMA is lower than the consolidation before it. Again here, that right leg is just about even, but because it comes off the 21 EMA, you can measure your risk and understand that that right leg push should signal to us that we're going to see more movement down, continuing this downtrend. See how candles are holding these EMAs very well, not breaking back up above the 21, holding that downtrend? These 2 and 3 candle reversal formations signal to us when the pullback is done and we're ready to get more movement in trend. So you can see it move down, move sideways, and once it got back to the EMAs, if the formation comes off correctly with that right leg in proper position off the right EMA, you're going to get more movement in the overall trend. And that goes back to me saying why I didn't want us to be contrarian, why I didn't want us to try to call the bottoms or try to call the tops. Just ride the trend. Like I said, the formation signals that a pullback is done and that trend is ready to continue. You can see we shifted down here, pulled back to that 21 EMA, and when that right leg closed lower, it ended up moving us lower, as you can see, all the way into the afternoon. Now, I just used the word shift. A shift candle is a very important breakout formation. This is the 3rd of 3 that you need to understand. This is when the 8 and 21 EMAs cross. Now, this will signal to us a shift in overall trend, and it can be represented with the 8 and 21 cross, but also by a large bar, which we sometimes call the shift bar. The best shift candles are going to come off the 21 EMA. You will see shift candles sometimes that are not off the 21 EMA, but the most probable setups with a shift candle will come when the open price of that candle, like you see in this example in front of you, is touching the red 21 moving average. So here you can see before the shift candle up, which is signaled by this strong bar compared to the previous bars, the red 21 EMA was on top of the 8 yellow EMA, which means we were actually in a short-term downshift here. But because we get a strong push off the 21, it pulls the 8 EMA through, and that signals to us that we're going to look to be long biased if that matches up with other confirmations of trend. But here, in this example, the shift candle shifts up, the body is off the 21, and look how all day it continues higher from there. Again, opposite, look at it inverted. You can see another shift candle there where the 8 comes underneath the 21 after being in an uptrend. The shift bar takes us down and moves us lower at about 3:30 in the morning there. Now, the candle formations themselves are great. And when we talk about in the next chapter our beginner entry signals, those are the candle formations that you're going to use. And then when we go into chapter 7 and talk about the advanced entry signals, they're the same formations. However, the difference between the beginner system and the advanced system is using this indicator right here, the TDI. The Trader's Dynamic Index is a combination of 3 unique indicators. It's an RSI with a 21 period applied to it, and it's also 2 moving averages with a 34 and 7 period average applied to that RSI. So those are the parameters when you're looking to put this indicator on your charts. If you go on TradingView, as I taught you in the earlier chapters, and search ASFX TDI, you will find this exact TDI for you to use. I've made it for you. It's free. It's easy to use once you're on TradingView. Now, the components of the TDI are, like I said, the RSI with 2 moving averages. The 2 moving averages are going to represent market sentiment and the trend line. Market sentiment tells us the direction we want to trade, where the trend line tells us the short-term trend. Those lines overlay over the RSI, the relative strength index, and combining all 3 of them is going to help us read and identify the most probable trends across the entire market. Because when you wake up and you look at the pairs, you want to make sure that you're not chasing after 10 different markets that day. You want to find the most probable setups and go after those. So let's break it down piece by piece. First, to talk about the market sentiment. This is the most important piece. This is what I want you to look at every day when you come to the charts. When you first look at the charts, this is where your eyes should go. This is the main factor for determining probability. It's going to tell us if we should be buying or selling, and it's labeled as the yellow line on the TDI. You can see it right here in this example. It starts above this stationary 50 value, it drops below, and then pulls up above it as the day goes on. Now, we'll add in the relative strength index, the RSI. This will show us the magnitude of price changes and determines overbought and oversold conditions, which is very important when using our advanced system checklist. This also is going to determine the buy and sell zones, and it's labeled as the green line on my TDI. And here you can see when I add that in, that's what the RSI looks like. On top of that, you want to add the trend line in. The reason I didn't give the trend line its own slide is because it's very simple. When we look and use this TDI, I'm going to show you how to use it for entries and exits. The trend line is the least important of the three, but it still needs to have weight in your decision. You don't want to go against the trend line. However, all you need to understand with what it is that it's another moving average applied to the RSI. It's weighted based on the RSI. The RSI part of this TDI creates two separate zones for us to trade within, the buy zone and the sell zone. This also creates the stationary 50, the value that separates the buy zone from the sell zone. If we're above that stationary 50 value, if the RSI value is 51, we're going to be considered in the buy zone. And if it's below the 50 value, we're considered in the sell zone. It's important to be able to understand this because when we're going long, we want to be in the buy zone. When we're going short, we want to be in the sell zone. So here I have the buy zone marked off for you. And here you can see I have the sell zone under that 50 value right there marked off for you as well. You can also determine, and I mentioned this already, overbought and oversold. When the RSI has touched 70 or greater, that's going to be overbought. So when the RSI has touched 30 or lower, that's going to be oversold. You should understand that we want to avoid going long after overbought has been reached and avoid going short after oversold has been reached. It's very important to keep that in mind. So in this example, when we reached overbought here, we would not look to buy it later in the day here or here. And notice how price does not break the high set once we reached overbought. Now, this is just one example. There's going to be other examples where it hits overbought and it still goes higher as the day goes on. But again, trading is about probabilities, right? You want to shift probabilities into your favor as often as you can. So once it has hit overbought or oversold, right, that's something that we should at least let it throw a flag in our analysis and say, hey, this could be better. How could this be better? It could have not touched overbought today. And that's a question we're going to constantly ask ourselves as we move through the next few chapters. Could this be better? The best question I've ever learned to ask myself in my trading is, could this setup be better? It's kept more money in my pocket, kept me out of bad trades, and helped me feel confident in the trades that I am taking. Here you can see oversold is also labeled on the chart. It hasn't reached oversold yet in this example, but I did want to highlight that 30 value for you. Here, like I was just saying, sometimes it will hit oversold, but continue lower into the next day. This vertical line right here, kind of faded, that separates the days as far as Monday to Tuesday, Tuesday to Wednesday. That's called a period separator. So you can see it hits oversold, let's just say on a Monday, but by Tuesday morning, basically, the RSI was higher than it was, but price action was lower. And we're going to go into that in more detail in the divergence section. But understand, just basics, that if it hits overbought or oversold, it can still continue higher. Like I say here, overbought or oversold doesn't mean that it can't continue in that direction. It means the probability is decreasing and strength of the move is slowing down. Here, overbought gives you another pop higher. The next day, it finally corrects itself and comes lower. Here, same thing, oversold and still gives you the opportunity to take it short. So when we talk about weighing overbought or oversold, keep in mind that if you're trading, and when we go into the next chapters and talk about our entry and exit signals, I'm going to say this again, but keep in mind that if it hits oversold on a Monday and you get a signal on a Tuesday, you could still trade that signal. But if it hits oversold on a Monday and you try to sell it again on a Monday, you're really hurting your probabilities. The next day is fine. You want to judge each day based on just that day's price action for the most part. Here, you can see hits overbought right here, and it still pops higher one more time before losing its momentum and coming lower, which is exactly what that RSI hitting overbought tells us that it's going to do. So now, I mentioned this a little bit already, but we're going to move into divergence. Now, divergence is a unique chapter because you can use divergence two ways. You can use it to keep you safe, or you can use it to help you identify potential entries if you're an advanced trader. But off the jump, let's start with how it can keep you safe. If you can identify divergence, you're going to be able to identify less probable setups, and you're going to keep more money in your pocket. Advanced traders will use this to actually enter trades because it can be powerful for us on both offense and defense. But off the jump, I would use, and this is just what's been successful for me, divergence to help keep you out of trades. That's the best thing you can do. Here is a great example of what divergence is. You can see price action continues higher, but the RSI is falling. And you know from our previous chapters about how to draw trend lines, we want to always start left to right. And when we incorporate a TDI into this analysis, I want you to start always on the TDI. So start with the RSI high, and you can see that the next point here where price action makes a high is actually lower on the RSI. That creates divergence where price action is moving in one direction and the RSI is moving in the opposite direction. And where does this end up going? Lower, because the TDI does not lie. Again, another example here. The RSI is falling all day, and it just kind of chops its way very slowly upwards, and that itself is divergence. So, will we trade this? Will I trade long into divergence in a situation like this? No, absolutely not. I would never take entries here as I'm trying to see the breakout of that line. I would wait for the break of the trend line before I traded it. But I would just use this to say, look, find a better pair. Go find a better setup. This isn't clean today. You can find something better. And again, another example. Oversold, RSI starts to rise, price action jabs down one more time, creates that divergence to try to fake out more people, pull people short, and again, because the TDI don't lie, RSI rises, price action rises. So again, the divergence is the signal to you, hey, you don't want to go short here. This is a bad idea. It's oversold, it's divergent, don't short it again today. It could come higher, and it does. Even here, not overbought, but divergent. And look how quickly this thing just fell right against you. So again, you guys are starting to get the point, I hope, about how to identify this divergence. Another one, oversold with a rising TDI. It has one jab left to kind of create that point. And when price action comes down for a new low here, but the RSI does not, if you were short, that's where I would look to get out of the trade. However, if you were waiting for a trade, this is where I would pull off and wait for a better setup. I would go look for a better currency pair. So now we spoke a little bit about market structure before, a little bit about the characteristics of the market, but let's talk about triangle analysis. I know that this is a unique term to me, but this is the easiest way for me to explain it to you because people will try to label pennants, wedges, all these different names to it. And when it comes down to it, to me, they're just basic triangles. So what you want to do is take the knowledge we spoke about on how to use a TDI so far, take the knowledge we spoke about on how to use trend lines, how to draw trend lines, and we're going to combine that together. Again, I said this a few minutes ago, but reaction points are going to start on the TDI first. You're going to use the low a day or high a day, and you're going to match those points on price action to identify trends, identify the trend or divergence. Here is a great example. You would start here at your RSI low for the day and connect it to your price action low of the day. The next point in this uptrend is clearly the first pullback in here, and if you match that on price action, you can see there is no divergence. This is a clean uptrend, and when that uptrend is broken, RSI falls and it ends up moving lower. So this is no divergence. This is clean trend drawing with the TDI in combination with price action. Here another one, RSI moving higher left to right, price action moving higher left to right. That's a signal to us that we can connect those points and draw trend lines. Again, another example here, higher left to right, higher left to right. You get the point, right? So now, combining the divergence, combining the analysis of these trend lines and triangles, we can start to identify every type of formation that we need to. You can see the wedge that forms here on the RSI, and you can see the wedge that's slowly starting to form here on price action. Notice how when the RSI breaks out of the top of the wedge here, price action does as well, and that's when we see the move out and higher from there. Notice RSI is rising from RSI low to price action low. So you see here the RSI low and price action low. If you connect those lines, it's falling on price action, but rising on the TDI. Where does that tell us it's going to go? Higher. You have to trust the TDI. It will not lie. So like I said, the triangles, the pennants, the wedges, to me, they're all the same. You group them all together as just triangle analysis. You always want to draw trend lines left to right. And I said this again, you're going to want to start on the RSI and match those reaction points to price action. This is going to point out the divergence in market structure to confirm or deny your trade ideas. And when you put the triangles together, it'll look like this. No divergence on the bottom, no divergence on the top, clean breakout of that triangle in a downtrend. You see the EMAs are all pointing down. 200 EMA is above the 50, so you're clearly in a downtrend. That breakout ends up falling as the RSI comes lower there. And notice also, we're in the sell zone. So now you should start to be putting things together with the TDI and with price action. If you don't find divergence and you can find clean trends on your TDI, clean trends on your price action, and clean trends with your EMAs, you're going to have a clear idea about where the direction is and which direction you should be moving. Here's another example. You can see the RSI is rising. It's in the buy zone. You get a breakout of that triangle, retest, and a move higher. Perfect market structure right there. Look at those pins to that exact zone that we had an issue with as we built the triangle. So again, it's not rocket science. You start on the TDI, you match those points on price action, and you're going to get solid formations like this. Look at the RSI moving higher here, price action moving lower. Here, price action is higher, price action is lower. It looks great. And what happens? It breaks out to the upside, breaks through the 50, and it moves higher all the way to the 200. It's a clean breakout there off the triangle. And even here, just using the basic trend lines. Of course, you could draw a line on top and it would be a triangle, but it doesn't matter. Just understand that when you draw these trend lines to make triangles, to make market structure, whatever it is, you have to start on the TDI. Start at your low a day or your high a day and match those reaction points on price action. Do not start on price action because you're only going to get burned. It's much easier to start on the TDI and work your way to price action and then say, okay, this is divergent, I'm going to stay away. Okay, this is not divergent, I'm going to look at this for an entry. Now, to summarize technical analysis, remember, the TDI does not lie. You're going to use market sentiment first, then you're going to start to look into overbought, oversold, ADR, all of the things we spoke about in this chapter to really start to narrow down how probable is this setup for me. You also want to make sure you're using trend lines to create market structure on that TDI and confirm it on price action. The EMAs and divergence are going to be used together to confirm or deny the trend. Let's say the EMAs are all pointing in one direction, but the TDI is a little divergent. TDI is in the right zone, though everything looks good except that divergence. You now understand that the divergence is still going to decrease the probability of that trade, no matter how good of a setup you think it is. You got to be unbiased and you got to read what that chart is telling you. Because remember, the confluence that comes from using multiple indicators will make you feel confident in the trades that you're taking, and that is the goal. If you can feel confident, even in one system right now, even when we go into the next chapter, just the beginner entries, even if that's all you're confident in, you got to use indicators the same way, stay consistent with it because it's going to give you confidence to take the trades you need to take. And that is a huge piece of successful trading, is having the guts, having the balls to pull the trigger. So understand, confluence from multiple indicators is going to make you more confident. Don't listen to what other people are saying. These indicators work, and if you use them consistently over the long run, they're going to provide you with massive profit potential. So I hope you learned something in this chapter. Now let's move forward into the beginner entry signals.